Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned to whap and tap on your head with another ADH wealth solution. Before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, ladies and gentlemen, I wanted to come here to Experian.com to talk to you about the pros and cons of brokerage accounts. And this is Experian, a credit rating bureau. The reason I want to do this is because I hear all too often about these people. I can start a $0 brokerage account, And whilst it sounds nice, there's reality behind it. So most of the time on social media, you only hear the pros of stuff, not the cons, right? Just like in life insurance, one of my favorite products to sell, there's pros and cons. There's pros to permanent life insurance, but there's also cons. Just like there's cons to term life insurance, but there's also pros. So you have to make sure that you get an unbiased opinion. So let's take a look here. Brokerage accounts let you easily buy and trade securities with flexibility to withdraw money at any time. However, brokerage accounts have some downsides, including taxes and fees. So generally you hear, oh, you can start a $0 brokerage account and they don't trade you a commission for trades. They do charge you something. There's going to be a fee in there somewhere. Now, generally you, as the consumer, don't see the fees because they're built in, but it'll be like a 0.5% money management fee. Or for example, when you invest in that mutual fund with Primerica where they have you spend $25 a month, well, they charge a 5% front load fee. What's 5% of 25? $5. So you're not even putting $25 a month in there, you're putting $20 a month in your mutual fund with Primerica, but you don't know that because you don't see the fees. So let's continue. It says here, opening a brokerage account can be an easy way to invest in stocks and bonds and other securities, either on your own or with guidance from the brokerage. Brokerage accounts are more accessible investment accounts than other options, such as retirement funds, but they also have their downsides, including fees and taxes. What is a brokerage account? A brokerage account is an account you can use to invest in securities such as stocks, mutual funds, and ETFs, bonds, and more. You can use a brokerage account to build wealth and save for financial goals such as retirement, home remodeling, a child's wedding, or other major expenses. I'm speeding through this because I have something to do in a few minutes. After opening and funding a brokerage account with an investment brokerage, you can either make your own investment decisions by buying and selling the stocks yourself, use a robo-advisor to choose investments for you, or have a human financial advisor manage your investments. Assuming you're already fully funding an employer-sponsored retirement account such as a 401k or an IRA and have an emergency fund, and don't have excessive credit card debt, a brokerage account can be a useful addition to your financial portfolio. But there are advantages and disadvantages to be aware of before you open a brokerage account. Pause. So, ladies and gentlemen, this is a problem because I hear all too often about people who ain't fully funding their 401k because they can't afford to at this year $23,000, but used to be $22,500. So let's use the old numbers. At $22,500, most people aren't fully funding their 401k at $22,500. Most people aren't fully funding their IRA at what used to be $6,500, now $7,000. Right? They're not fully funding their IRA. Most people don't have 6 to 8 months of their expenses in a savings account. Statistics show most people don't have access to $1,000 in the event of an emergency. So you have no business doing these things, which are speculative, which means even though, yes, you can make money, you have a high likelihood of losing. But let's continue. Pros of brokerage accounts. Brokerage accounts offer several advantages that can help you make the most of your money. They allow for easy diversification. Brokerage accounts give you the freedom to allocate your investments based on your financial goals and risk tolerance. Most people have no clue what their risk tolerance is. Diversifying your portfolio by investing in a mix of assets such as stocks as bonds, as well as buying investments in a range of locations and industries that can help reduce risk and minimize any negative impact of market ups and downs. They're relatively liquid. Although your money isn't quite as accessible as it would be in a checking account, a brokerage account lets you withdraw cash whenever you like without paying penalty. Though, if you're cashing out investments, it will trigger capital gains taxes. In contrast, withdrawing money from tax-advantaged investment accounts such as a 401k, 403b, IRA, TSP, etc. before age 59 and a half can trigger income tax penalties plus a 10% penalty on the amount you withdraw. So usually if you're before 59 and a half and you withdraw from one of those accounts, you'll incur a 30% penalty tax basically. Easy to open. You can generally open a brokerage account online or in person in a matter of minutes by providing your personal information, annual income, tax status, and tolerance for risk. You may even be able to open a brokerage account with no money. No RMDs. Tax advantage retirement accounts usually require you to start taking RMDs at age 72, which as of next year will be age 75, and pay income taxes on them unless you're withdrawing money from a Roth IRA. If you don't take your RMD, the amount you should have withdrawn will be taxed at 50%. Brokerage accounts don't require RMDs. There's no contribution limits. So retirement accounts cap the amount you can contribute each year, which can limit your investment's potential for growth. For 2023, you can contribute a maximum of $22,500 to a 401k or 403b, $6,500 to a Roth or traditional IRA, and people 50 and up can make additional catch-up contributions of $7,500 for a 401k and $1,000 additional dollars for an IRA. You can put as much as you want into a brokerage account. Accounts are typically insured. Pause. So why is it, ladies and gentlemen, that you won't open a bank account unless it's FDIC insured? You won't mess with a professional unless they're insured, yet you won't get life insurance. Make that make sense. Accounts are typically insured. Brokerage firms that are members of the SIPC, Securities Investor Protection Corporation, which includes most brokerages registered with the SEC, Security and Exchange Commission, insure your account for up to $500,000. Should your brokerage go out of business, half of that, $250,000, can be used to cover cash. Keep in mind, however, your money is not insured against investment losses. Now let's look at some of the cons of a brokerage account. Brokerage accounts have some downsides to consider as well. They may charge fees. You're likely to encounter a variety of fees when you open a brokerage account and purchase investments. These can include annual fees, account maintenance fees, management or advisory fees, and fees for purchasing or selling the investments. They're taxable. Some tax-advantaged retirement accounts don't tax your deposits. Instead, you'll pay taxes when you take distribution in retirement. Brokerage accounts tax you on earnings when they are realized, which usually happens when an investment is sold or a dividend paid. They involve risk. When you put money into a traditional or high-yield savings account insured by the FDIC, Federal Deposit Insurance Corp., or NCUA, National Credit Union Association, your money is guaranteed up to $250,000 per person per financial institution. The SIPC insures member brokerage accounts if your brokerage fails, but it doesn't protect you against losses if your investments decline in value. Purchasing investments inherently involves risks. You'll need to strike the right balance between safer investments that typically deliver lower returns and riskier investments that have the potential for a bigger payoff and bigger losses to ensure your investments are diversified. They may have minimum deposit and balance requirements. Although some brokerages allow you to open accounts for free, others require an initial minimum deposit, which could be thousands of dollars. You might also have to maintain a certain balance in your account to avoid maintenance fees. The bottom line, You can build a foundation of financial security by contributing to your workplace or individual retirement account, paying down debt, and building a solid emergency fund. If your budget allows, opening a brokerage account can be a convenient way to expand your options. Weigh the pros and cons of opening brokerage accounts before making your decision. Purchasing investments doesn't affect your credit scores unless you open a margin account. With this kind of brokerage account, you can borrow money from the brokerage to purchase stock. The brokerage may check your credit when you apply for a margin account, which could cause a small, temporary drop in your credit score. If the value of your investments drop too far, you might struggle to repay the money you owe to the brokerage. Should your account be sent to collections, it could damage your credit score. You can avoid this risk by opening a cash account, which doesn't involve borrowing money. So that's it for today, ladies and gentlemen. Wipe ass, work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.